Our next panelists can come to the stage so long.
Used to the lower inflation target. So going into 2025, we had the tailwinds of a lowering interest rate environment. We had entered into the adventurous time of the formation of the Government of National Unity, and our adventure in load shedding had sadly come to an end. So with those tailwinds, we were projecting an increase in investment volume in South Africa in 2025. And that's really the theme of the talk today, is to analyze investment volume in South Africa. So in order to answer the question of what the investment landscape looks like, JLL has, over the past 10 years, tracked transactions above $1 million or 20 million rand. And from that process, we've been able to extrapolate or draw interesting conclusions and identify trends. So 2024 was a record year in South Africa. We got to 27 billion rand in investment volume. And despite our projection at the end of 2024 that 2025 would be a record year or a very good year, and this trend would continue, we're actually at the first half of the year on track to have the worst year in terms of transaction volume since we started tracking this in the 10th year of the assessment. If one doubles the 6.9, we'd get to roughly 14 billion at the end of the year. And there haven't been any major announcements that would indicate that we won't be having the worst year on record in terms of transaction volume. But I think the most important, before I get to the most important trend which we've picked up on this year, sectorally, how it's split up is retail and industrial make up about 30% of the sector. Roughly, that's the top right-hand chart. And then offices used to make up 30 to 40% of the total investment volume. That's dropped down to about a quarter now. Last year was an outlier, and I'll explain why shortly. And then the alternatives are taking up about 15 to 20% of total investment volume. The main theme we want to draw your attention to here is the Western Cape, which is sort of that dark blue part of the column. It's been increasing its market share. And in the first half of 2025, it's made up half of the South African volume. This is a fundamental shift in the ecosystem, in the South African property investment ecosystem. Gauteng's dominance has been whittled away. It in 2021 took up 2/3 of the market and had done that historically, and it's dropped down to 1/3. It's basically halved. So Gauteng's dominance as a investment hub is no longer the dominant investment destination. Another theme that we've picked up on is that transaction count has been increasing year on year. That's predominantly due to the fact that REITs are net sellers, and they're selling smaller non-core stock because of pressure on LTVs and effectively on the balance sheet of the listed REITs. And that's basically what we're going to summarize on the slide. A lot more smaller deals are happening. Delving into the different sectors, retail, as I mentioned earlier, makes up 1/3, roughly, of the total investment market. Last year, we saw almost 8 billion rands worth of transactions in shopping centers. It was that data is a little bit skewed because of the fact that Rebosis, a mid-cap to large-cap REIT, was undergoing a business rescue process and sold 4 regional shopping centres out of the 6 regionals that sold last year. The main thing we sort of want to draw your attention to there is that column, which is Western Cape retail. Outside of the Rebosis portfolio that sold, Western Cape retail sales increased dramatically, with Table Bay and Eden Meander and George exchanging hands. And those capital values were significantly higher per square meter, were significantly higher than like for like in the other provinces. Another theme in retail is that the number of shopping centres disposed and sold and bought each year has increased, which means there's a trend towards buying convenience and neighbourhood and community centres that's become more prevalent. And that's because of, in part, due to the fact that neighbourhood and convenience centres have stronger trading densities and performance, particularly after the pandemic. Industrial. What was surprising and noteworthy in 2024 was the fact that no large distribution centre exchanged hand, i.e. a big warehouse or DC, none of those exchanged hands in 2024, but we still achieved 7.4 billion in transaction activity in South Africa, which is indicative of real strength in this sector. There were hardly any distressed sales in 2024, as the Rebosis portfolio doesn't really have any industrial assets in it, and it achieved a strengthening. So again, a record year in terms of count. 125 industrial facilities sold above 20 million rand in the year, which is a trend that said it would continue, but in 2025 there's been a drop-off. It's not really a matter that, it's not because there's a flight out of the sector really, it's because a lot of the non-core stock has been sold. There's very limited stock in the Western Cape particularly available for sale, and there have been some announcements on DCs that are going to sell in the next 12 months, but there weren't any large DCs that exchanged hands in the first half of 2025. Offices, one might think this indicates a return to office, 8.2 billion rand last year, 2024, exchanging hands. The majority of the Rebosis portfolio is made up of inner city government tenanted offices. Those exchanged hands predominantly in Johannesburg and Pretoria last year. So that is a total outlier. Those capital values per square meter were relatively low. The 2.5 to 3 billion range is where we think it's going to stabilize at. Historically, in 2016, 17, 18, the office sector would typically trade about 6-7 billion rand a year. It's halved, and we don't see that necessarily changing going forward. One thing to note here again is the Western Cape, the 2 billion that happened in the Western Cape, those were investment grade assets, A and B grade offices that exchanged hands at relatively high capital values per square meter. So it's not the drop-off that happened since 2016 hasn't decimated the sector. Investments into the sector have to be analyzed on a case-by-case basis, and location of the office, of one's office that one were to acquire or dispose of is critical. It really is. There's a huge divergence in capital values per square meter in certain nodes. So, and there's a lack of liquidity in the sector. Then in the alternative space, which is living, built to rent, purpose-built student accommodation, hospitality, data centers, you name it, all the alternative asset classes. It's relatively nascent in South Africa. There's not a lot of activity. As I mentioned earlier, it's about 15% of the sector in total. There's some outliers that crop up. The 2021 beige bar chart there are student housing platforms that sold. 2024, the beige, part that's Gauteng alternatives were driven by large office conversions that sold. So it's indicative of student housing perhaps and built to rent, starting to mature, and we're seeing secondary exchanges of platforms. Then also in the 2024 column would be the large hotel deal that Wayne brokered, I think is there. So we were responsible for some of those, luckily, as JLL. I want to, before concluding, discuss broadly what happened in 2024 from this perspective of what the types of buyers, who was buying and who was selling. It was a record year, but a third of the transactions in the year weren't open market transactions in the typical sense. They were either distressed sales, business rescue, banks putting pressure on for the likes of Accelerate to dispose, and then internal dispositions between sister companies made up roughly 10% of the market last year. So in conclusion, there's some adventurous themes that have emerged, and I'd like to touch on those. There are three of them, really, in summary. There's a decentralized investment beyond Gauteng happening in South Africa, which creates opportunities in previously overlooked markets, such as Cape Town and perhaps the Winelands, or the Western Cape in general, George, and those outlying markets, where we're seeing a lot more liquidity and interest in those areas, being driven really by investor-friendly policies and functioning municipalities. So if one were to look at location, the municipality in which the subject property is located is very important, that it's functional. If not, the property owner's got an incumbent on them to create off-the-grid type of self-reliance. Then neighborhood and convenience retail and community retail, and by extension, township retail, are in strategically located areas are seeing a relatively lot of liquidity and interest. And as would strategically located industrial and safe areas, again, with functional municipalities supporting those assets. Offices, as I mentioned earlier, have to be assessed on a case-by-case basis. If it's in a secondary node, there's a significant pressure on capital values per square meter. Then the trend of smaller deals, with REITs being net sellers, is set to continue in the medium term. Some REITs have raised capital and are starting to acquire, but it is still the minority. So short term, there'll be more smaller deals happening with high net worths and private funds, either buying opportunistically or buying with a long-term view, securing assets which they might not in another stage of the cycle have access to. So in general, there's a flight to quality as opposed to a retreat from commercial property in South Africa. And the question is not whether there are opportunities in the commercial real estate market in South Africa. The question is who's adventurous enough to take advantage of those. Thank you. And I look forward to the discussion for the rest of the summit.